Right, good afternoon then everyone, as we are at the beginning of another week of trading on Monday, the 23rd of September. We'll have a look across the calendar on a pretty quiet week this week, really, from the data front. I've had some European data out this morning, which was extremely bad, which has caused kind of euro dollar to sell off by 60, 70 pips, but we'll have a look at that now in a minute. We do have the RBA out. I can't imagine too much from the RBA tomorrow. They're not going to change interest rates. Interest rates are going to stay where they are at. The likelihood is the interest rates will stay there through to year end. Where they end up next year is really anyone's guess. I mean, we can look at these predictions from the central banks, but ultimately it's pretty difficult for them to predict 6, 12 months out. So we'll see what they have to say for themselves tomorrow morning. What I would say is inflation's still up with 3.5%. Back in the July figure, the quarterly figure that they look at, you do get this monthly CPI indicator on Wednesday morning, which is expecting to slow down to 2.8, which will be the first time it's been below 3% from this metric dating back to August of 2021. So been a while above their target range of 3%. Obviously about 3 years now, or just over 3 years. So I mean, central banks, I was going to say they'll probably be hesitant to cut interest rates the second it gets down, but I suppose when you think about every other central bank, the second it gets to 3%, they're all whacking interest rates lower. So, yeah, they'll probably want to get interest rates a little bit lower. But the fact that, the UK, they had 5.25, the US, they had 5.5. The European economy probably calls for a little bit more. Canadian inflation has come down, but they started from a higher amount as well, up in the 5%. So the RBA only have their interest rate at 4.35, so it's not as restrictive as some of the other central banks. So they do have a little bit more give in order to be able to wait a little bit longer in order to get inflation back under control, which then is maybe a reason why inflation is still isn't under 3% as of yet. Probably likely is to be on Wednesday if you go off the market consensus. But yeah, what that means going forward, I still think there's a bit of support for the Australian dollar relative to some other of the central banks. You look at the ECB, they will probably have to cut rates again now in September, in November, should I say, especially after this economic data that they've had, or October. I think it's October 27th, I think, off the top of my head. I could be wrong on that one, so don't quote me. Back end of October, we'll get another rate adjustment probably from them. You've got the Bank of England, who, I suppose, Bank of England, I doubt they'll cut again through the year end, but you certainly got the ECB, you've got the Bank of Canada, you've got the Fed all cutting interest rates, while the RBA probably won't. So you'd have to imagine somewhat supportive for the Australian dollar, especially if that monthly CPI indicator on Wednesday comes in above consensus. So once equities don't sell off, should theoretically be an idea to go long, or to go long Australian dollars against a few of the other currencies. But I suppose if the markets start playing a global economic slowdown, which they probably will over the coming months, then that becomes somewhat troublesome for the Australian dollar. So probably near-term longs, or short-term longs, should I say, on the Australian dollar, probably better bet will come up more medium term. You probably imagine that begins to weaken, especially when they go and cut interest rates. Global economy continues to slow down. That's an issue for the Australian dollar, but we'll play that game when it gets to it. For now, certainly in the short term, probably better idea being a bull than a bear on the Australian dollar. In terms of US economic data, you can see durable goods orders on Thursday, previous and plus 9.9%, consensus minus 2.6%. So that's all a bit choppy. Durable goods orders in the last number of months, you can see 9.9, then down 6.9, then flat for a few months prior. So yeah, it's kind of a bit all over the place, really, in the last number of months. So I'm not so sure that's really the most reliable of data points at this point in time. Q2 GDP, if that comes in about 3%, that's still not a bad thing for the US economy, although they are cutting interest rates. So doing that, obviously in anticipation for some difficulties to come. Core CPI is supposed to be in line with that 0.2%. Wages supposed to outpace inflation, which is a good thing for the general population. But yeah, core PCE, the Fed's preferred metric of inflation, expected 0.2%. So if it comes in at 0.2%, which is obviously what is expected, I can't imagine too much happens off the back of that. That's all Monday next week, and we'll cover that when we get to it. But interesting start to the week across Europe. You do get these business climate figures out on Tuesday morning, get these consumer confidence figures out on Thursday morning, but bad economic data from Europe this morning, pretty much across the board. You look at France, you look at Germany, you look at Europe, right? All these extremely bad across Europe, but especially in Germany and in France. You can see this manufacturing PMI at Germany, 40.3. Right, remember that is based off of a number of 50. Anything below 50 is considered contractionary, and that is obviously not a good thing. Right? And that has prompted, you can see, euro dollar to sell off kind of post that or pre that release, then 60 pips lower after that within the kind of hour after, 76 pips lower at one point. So that can't be a good thing for the euro. They're probably gonna be forced, the ECB, to cut interest rates sooner than maybe they would have hoped for. But if the global economy slows down in the coming months, which it looks like it is going to, that is difficulty for really any currency that's not the US dollar, the Japanese yen, or the Swiss franc. But that's a little bit off for now. I think selling the euro is a good idea. Euro Aussie, Euro sterling shorts probably on the agenda this week. Dollar yen kind of trending higher. It's really the only one of these FX pairs that has any sort of direction. You look at these are just all over the place at the minute. Dollar yen's the one with clear direction with higher lows and higher highs, which is Japanese yen weakness. So central bank reluctant to hike interest rates again in the near term, judging off what they said last Friday. So I think being short the Japanese yen is probably a decent idea, but I think this week certainly being short euros, especially if that data tomorrow and Thursday comes out where you would want it to be, in line with the with other poor economic data. So again, same thing with a chart. You got to look for trends in the economic data. If we can get a trend out over the rest of this week, should be some good opportunities to sell the euro to come up. Stock indexes don't really know what they're doing. You have a look across here. Bond yields, 10-year yield rising, more normal yield curve unfolding, longer dated yields rising, shorter dated yields they're not doing much over here. So yeah, 2-year yields kind of priced for the near term interest rate cuts that we did get told were going to happen from the Fed last week. Expecting the Fed officials expect interest rate through the year end last week to be down at 3.5%. All right, 2-year yield is at 3.5%, or just above 3.59 or whatever it is at this point in time, in and around that figure. All right, it's kind of close to that. So there's not too much really to do one way or the other in terms of that. So we can kind of move on from the Fed last week, see what happens going forward. But I think stocks will. Do they need another catalyst to go higher? I mean, you don't ever want to get married to a trade idea, but if you are going to get married to some sort of trade idea, it would be long stocks up here at the highest. Though it's a tricky one. Cutting interest rates by 0.5% when stocks are at all-time highs, it's not really how things are supposed to work. So I still think continue to go long stocks. I don't say that with much sort of certainty. I mean, obviously nothing in markets is certain, but I still think that's probably a better way to go. Certainly is over the longer run. Is it the clearest picture in the world for stocks? No, it is not at the minute. But I think the way stocks work, if nothing happens, they go higher. So if nothing happens, then obviously you expect them to go higher. So I do think probably short euros are a slightly better trade this week. Short euro Aussie, short euro sterling, probably your best bet. And if the euros do go short, euro dollar will go short. I may eke a bit of direction across the board in US dollar, but certainly I'll be focusing on euros. Be interesting to see what stocks do. Let me see the CAC around lower, DAX lower. I mean, it's higher post release. It doesn't make too much sense, but anyway, expectations for interest rate cuts, no doubt they'll put it down to. But yeah, I'm not so sure these are your best bets this week. Now, gold, the fact that we're coming into a cutting cycle, potentially into a global economic slowdown. I don't mean recession when I say that. I might end up in recession, but certainly a global economic slowdown, interest rate cuts, positive environment for gold. So I wouldn't hesitate to be long gold, certainly over the next weeks and months. How long that goes for, the fact that it's already at all-time highs is anybody's guess, but I think that's the side of the fence you've got to sit on. So probably gold longs, euro shorts, maybe some Aussie longs if they play a ball tomorrow at the RBA. We'll cross that bridge when it comes to it. Euro and gold will be main focuses of attention for me throughout the duration of this week. So best of luck out there, everyone. Stock in the markets and see what you can find, and we'll update further as we go on through the week.